So now let's talk about the seminar. Let's start with question number 1. For question number 1, very simple. The question asks you to calculate the division net profit. And as you see, we have division, the total sales of the division, 150,000. We have controllable cost, 50,000. And I mentioned about what's the difference between controllable cost and non-controllable cost, if you remember. 30,000 non-controllable cost. I mentioned about it, the difference in the lecture. So please go back. We did say that controllable cost, the division can control the cost, such as the labor wages. The non-controllable cost, the 30,000 pound, the business or the division has no control over it, such as the insurance or the rent. And the common fixed cost, which is from the head office, is 20,000 pound. Okay, fair enough. Here we go. Just apply the formula and that's it. So as you see, sales revenue 150 minus 50, which is the controllable one, equal 100, the controllable profit, and minus the non-controllable cost, which is 30. That gives you 70, and of course at the end what you need to do, you need to deduct the 20, which is the head office charge that comes as 50. Yeah, very simple. Yeah, good. Okay. Right. So as I mentioned, we'll cover today question number 1, 2, and 7. So question number 2 here. So this company, division R, is a division of RC code. The following data relate to division R. Okay. We have a capital employed of 40 million pound. Profit before interest and tax, 8 million. And we have cost of capital, 10%. RS company is considering 2 proposals. The first one, to invest further 5 million in fixed assets to earn annual profit of 2 million. Fine. The second proposal, the dispose of fixed assets at their net book value of 25 million. And what? And this would of course lead to profit falling by 1 million per annum. Okay. So there, for this question, as you see, there are 2 proposals, proposal 1 and proposal 2. And the question asks you that you need to calculate the ROI and RI for division R. Okay, that's the first thing you need to do. And the second, you need to consider the 2 proposals and show how the ROI and RI would change if these proposals adopted. So let's have a look now. Let's start now. First of all, you need to forget about the proposal now, proposal 1 and proposal 2. Forget about them. Now what we need to do, and calculate the proper ROI and RI. And if you go back to the lecture slides, you just need to use the formula in order to calculate it. So which is the ROI, which is the profit before interest and tax divided by the capital employed by 40 million. So as you see, 80 divided by 40 equal 20%, of course, times 100 equal 20%. So this is the return on investment. Okay, let's make it in blue. Yeah. So the residual income, if you go back to the formula, which is the profit before interest and tax minus open bracket 40 million, which is the capital employed, times the minimum cost of capital, which is, or the minimum return, 10%. So if you apply this formula, you should be able to find the residual income equal 4 million. Fair enough. So now what we're gonna do right now, we're gonna consider the two proposals, which is proposal 1 and 2, and find out what is going on. Let's start with proposal 1. So proposal 1, you invest a further 5 million in fixed assets, which is the capital employed, okay, which is now 42 million now. 45 million right now, because it comes to the, okay, invest further 5 million, so that's the 40 plus 5, that's 45 million, to earn annual profit of 2 million. So now the annual profit is what? Is 10 million, because there's extra 2 million. Okay, based on this information, right, if we calculate ROI, it is a 22.22%. Yeah, so let's put it in another color so we can differentiate the proposal. Okay, red. Okay, so again, guys, 10 million, which is a profit before interest and tax, divided by 45, which is the capital employed, time 100%. So that's 22.2%. Fair enough. RI, which is the residual income, if you apply the formula again based on the new figures, it's 5.5 million. Okay, that's proposal 1. That's proposal 1. Fair enough. Okay, would you accept proposal 1? Of course, would accept proposal 1. Why you accept proposal 1? Why would you accept proposal 1? This is when you need to do it and write it in the exam, because of course you were gonna tell me that based on the figures, proposal 1 can give the division or the company, whatever, a higher percentage of a 22.22%, higher than a 20% without the proposal. Fair enough. So there is an extra of 2.2%, which can really help the business. Also, in terms of ROI, as you see, there is extra 1.5 million, which is above the 4 million pounds. Okay, so very simple. Yes, accepted. We accept the project because it does increase ROI and RI. Fair enough. That's based on proposal 1. So what we need to do right now, we need to look at the proposal 2. Okay, let's have a look at proposal 2. Okay. For proposal 2, dispose of dispose of fixed assets at their net book value of 5 million, right? So what does that mean? Now we need the capital employed is 40 million now. We need to dispose 5 million. So this is now 35 million. So the capital employed right now is 35 million. So when you consider proposal 2, guys, please ignore proposal 1 right now. They are separate. 5 million, so the capital employed right now would be 35 million, and this would lead to profit falling by 1 million. So now the profit would be, instead of 8, would be 7 million. Okay, based on this, again, what we need to do, we need to calculate the ROI and RI. So if you look at proposal 2, so you can see that based on ROI, so the percentage is a 20%, and the RI, it's a 3.5 million, 3.5 million. So if you look at these figures, which I'm gonna do them in another color, purple, fair enough. So what do you think? Would you accept it? Right now, what you need to do, you need to compare these with these and find out. Of course, as you see, we shouldn't accept really proposal 2. Why? I understand that's 20% remains the same, but how about the RI? Can you see the RI what's going on, guys? Yeah, dropped by 500,000. and that's why it shouldn't be accepted. So when you write the comments, what you need to do, so you advise the business or the division to accept proposal 1, because as you see, the proposal 1 can give the highest ROI and RI. Yeah, fair enough? Fair enough. Good. Well done. That's question number 2, guys. And question number 7 next. As I mentioned, for EVA, guys. So EVA only for you guys to read. It's very simple anyway, but it is only for you, additional information for you. And as I mentioned, you will not be assessed numerically in the exam. You might have some theory questions on EVA, yeah, but not numerically. Right, what is question number 7? Okay, dokie. Question number 7, what I'm gonna do right now, I'm gonna look at question number 7, which is next one we're gonna do right now, guys. So okay, dokie. Okay, I'm gonna do, where is the question? Okay, let me go to the question. Here we go. That's a question. Here we go. Okay. Right, question number 7 here. So we talk about, okay, let me copy paste it. Okay, I'll just leave it, to be honest. Anyway, question number 7, guys, as you see here. So Helen Limited is an organization with 3 autonomous divisions. The divisions are evaluated on the basis of the return that they are able to generate on invested assets, with year-end bonuses given to the divisional managers who have the highest return on investment. Operating results for the company's product division. So we have that division called PD, and as you see, for 2020, these are the information. Okay. Sales minus variable expenses equal contribution margin minus fixed expenses equal operating profit, and that gives you the division operating assets 2 million. The company had an overall ROI last year 15%, considering all divisions. The division PD has an opportunity to add a new product line. There's an opportunity for a new investment that would require additional investment in operating assets 500,000. So that's the top of 2 million. As you see, this is 2 million pound. It's the divisional operating assets, which is the capital employed. So the new investment requires the additional 500,000. The cost and revenue information for the new product. Now it talks about new product. Sales variable expenses, which is 60% of sales. So you just multiply this by 60%. And of course you need to do the contribution margin, and fixed expenses 320,000. Okay. Okay, longer question, but simple. So first of all, we need to calculate ROI without the product line, new product line. Just ROI, just calculate ROI, as you know. Yeah. Okay, let's do it. What is the formula, guys? Operating profit, which is profit before interest and tax, divided by what? Divided by capital employed, 2 million. Yeah, fair enough? Yeah, fair enough. Here we go, 20%. 20%. Now, the question, the second question asks you what? The second question asks you to what? To calculate it based on what? Based on the product line. Where is it? Where is the question? Here we go. calculate ROI for the new product line only, right? So what does that mean? This means do not add the 500,000 on the top of the 2 million. Yeah. So the capital employed would be 500,000 divided by the profit, which is you need to calculate it right now. So profit would be the 1 million times 60% equals 600,000. So 1 million minus 600,000 equal 400,000, and 400,000 minus 320,000 fixed cost equal 80,000. So the profit would be 80,000. So 80,000 divided by 500,000. Okay. Yeah. So 80,000, which is, this is the way we calculate it, guys. Yeah. If then you divide it by the capital employed for the new product line, 500,000. So 16%. Okay, here we go. So as you see, the PD will be inclined to reject the new product line, since accepting it would reduce the division's overall rate of return, as you see. So of course they were rejected. And the new product line promises an ROI of 16%, whereas the company overall ROI last year was 15%. So that's again, it's really it's a contradict, isn't it? So adding a new product line would increase the company's overall, and that's why we talk about the contradiction here, isn't it? When we talk about the difference between the company and the division. So thus adding a new product line would increase the company's overall ROI figure, assuming that higher return than 16% cannot be gained elsewhere on some other investment opportunity. Okay, so that's the way, guys, you need to comment, and that's the way you need to compare the results. And that's what to do with ROI. So the same stuff here, the same stuff we will calculate based on ROI, the residual income. So now, when you talk about residual income in the question, so anyway, the figures is ready, guys. So what you need to do, that's it. So just, you know, the formula, isn't it? Which is the profit, which is 400,000, minus, open bracket, the capital employed 2 million times 12%. Why is 12%? Because in the question, look at the question here. Okay, can you see? Where is the question? Yeah. Suppose all the company's views as to return 12% on investment assets as being the minimum that any division should earn. The performance is evaluated by the residual income problem. So very simple, that's 12%. So that's £160,000, and based on the new product is £20,000. Again, under the residual income approach, the BD would be inclined to accept the new product because it's positive. As long as it's positive, that's it, should be fine, since adding the line would increase the total amount of the division's residual income as shown above. Okay. So that's all, guys, what to do with question number 7. Very simple, very basic. As I mentioned many times, when it comes to return on investment, when it comes to residual income, the key is to know the mechanics and just understand the figures, and just makes your life easier. That's from me, guys. Thank you very much. Have a lovely day.